If you walked into a government printing facility today, you would see sheets of paper becoming dollars, ink, cotton, serial numbers. It feels powerful, concrete, real. But here's the uncomfortable part. Almost none of the money you use every day was created there. Not your paycheck, not your credit card balance, not the number sitting in your savings app. Most money isn't printed, it's typed into existence. And the people typing it are not politicians. They're not central bankers running giant printing presses. They're commercial banks. Which raises a simple, dangerous question. If the government doesn't create most of the money, who does? And what does that mean for you? Because right now, in a world drowning in debt, rising rates, and quiet banking stress, understanding this isn't optional anymore. It explains housing prices. It explains inflation. It explains why recessions spread so fast. It even explains why your bank suddenly cares about how much you borrow. Let's start with something that sounds small, but changes everything. When you deposit $1,000 into your bank account, it feels like you've given the bank your money for safekeeping, like a locker. You imagine it sitting there. It's not. The moment you deposit that money, it becomes the bank's asset. In exchange, they give you a liability, a promise they owe you $1,000 on demand. That promise is what you see in your app. Now here's where it gets strange. When the bank gives someone a loan, say a $300,000 mortgage, it does not transfer someone else's deposits. It does not open a vault and move stacks of cash. It simply creates a new deposit out of nothing. It types $300,000 into the borrower's account. New money. That $300,000 did not exist 5 minutes ago, and now it does. This is not a conspiracy theory. It's how modern banking works. In most developed economies, over 90% of money is created this way, through bank lending. The government prints physical cash. Central banks manage reserves and interest rates. But commercial banks create the majority of spendable money. Which means every time you swipe a card, buy a house, finance a car, or expand a business with a loan, new money may have just entered the system. And here's the catch. Every dollar created this way is born with debt attached. Money enters the economy as someone's obligation. There is no new money without someone owing it back. So if most money is created through loans, what happens when people stop borrowing? Or worse, what happens when they can't pay? To see why this matters right now, we need to zoom out. Picture the economy as a bathtub. Loans turn on the faucet. Loan repayments open the drain. When banks are confident, they lend aggressively. The faucet gushes. Home prices rise. Stock markets climb. Startups get funded. Spending feels easy because money supply is expanding. But when banks get nervous, maybe defaults rise, maybe the economy slows, they tighten lending. Fewer mortgages, stricter credit cards, harder business loans. The faucet slows. Meanwhile, old loans are still being paid back. The drain keeps flowing. That means money supply can shrink, not because the government printed less paper, but because banks created less digital money. This is the quiet mechanism behind many recessions. In 2008, when housing collapsed, banks didn't just lose money, they stopped lending. And because most money is loan-created money, the economy didn't just slow, it contracted. Less lending meant less new money. Less money meant less spending. Less spending meant layoffs. Layoffs meant even fewer borrowers. A feedback loop. The scary part? No dramatic announcement. No emergency sirens. Just banks adjusting risk models behind closed doors. And the money supply quietly shifts.
Now here's where it can become even more uncomfortable. If money is created through debt and the system needs new debt to grow, then growth itself depends on people and businesses continually borrowing. Think about that. For the economy to expand, total debt must generally rise, because paying off debt destroys money. When you fully repay your mortgage, the bank deletes that deposit from existence. Money disappears. So the system constantly needs fresh borrowing to replace old repayments. This works beautifully during optimism. It works during home booms, tech expansions, low interest rate eras. But what happens when interest rates rise sharply, like they have recently? Borrowing becomes expensive. Demand slows. Mortgage applications drop. Corporate debt issuance falls. Banks tighten. The faucet slows again, and suddenly the system feels fragile because it was built on the assumption that debt keeps expanding. This also explains something that confuses many people: why governments can stimulate the economy but still struggle to control inflation. During crises, central banks lower interest rates or buy assets to encourage lending. They don't directly create most spendable money. They try to influence banks to create it. If banks lend, money expands. If banks hesitate, stimulus weakens. The government sets the stage. Commercial banks decide how much of the play actually happens. There's an irony here. We often imagine central banks as all-powerful, but in reality, they steer incentives. They don't directly control how much money gets created day to day. Private banks do, based on profit, risk appetite, capital rules, which means money creation is tied to lending incentives, not necessarily social priorities. Banks are more likely to create money for real estate speculation than for risky innovation, more likely to fund assets with collateral than ideas without it. That shapes the entire economy. When easy money flows into housing, prices rise. When lending favors financial assets, markets inflate. When credit tightens, everything feels scarce. The power isn't just in printing, it's in deciding who gets credit and who doesn't. Now let's address the quiet math problem underneath all of this. If every dollar is created with debt attached, and that debt includes interest, where does the money to pay the interest come from? It comes from new money created by new loans, which means the system requires expansion to stay stable. If lending stalls for too long, stress builds, defaults rise, banks pull back further, money shrinks. It's not a pyramid scheme, but it is a system that prefers growth, strongly. And this is why financial crises feel sudden, because they often begin in credit markets, not in factories or stores. The visible economy is the surface, the invisible credit system is the engine. Right now, globally, debt levels are historically high. Governments, corporations, households. At the same time, interest rates are higher than they've been in years. That combination makes the credit engine more sensitive. When borrowing slows, the impact is faster, more amplified, because so much of our money supply is loan-based. There's another layer. Digital banking has made money creation even more abstract. No vaults, no trucks of cash, just balance sheets updating in milliseconds. The system is stable as long as confidence holds, because banks don't need to hold cash equal to all deposits. They rely on the fact that not everyone withdraws at once. That's why bank runs are terrifying, not because money vanishes instantly, but because confidence does. When confidence breaks, credit tightens. When lending tightens, money creation slows. When money creation slows, the economy contracts. It's psychological and mathematical at the same time. Which brings us back to the original question. If the government doesn't create most of the money, and banks create it through debt, who really controls the money supply? In practice, It's a partnership. Central banks influence the cost of credit. Governments regulate capital and guarantees. But commercial banks decide who gets loans tomorrow morning. That decision determines whether money expands or contracts quietly. So the next time you hear someone say they're printing too much money, remember this. The printer isn't the main story. The loan officer is. The underwriting model is. The risk committee meeting no one live streams is.
All
Money
right, here we
today
go.
is not
It's
primarily
working. Look at
paper.
him go.
It's permission.
Yes, jackpot.
Permission to borrow, permission to expand, permission to create new deposits, and permission can be tightened or revoked. We built a system where money is elastic,